Nick Leeson. In February 1995, a 28-year-old trader named Nick Leeson woke up in Singapore and realized he'd destroyed a bank. Not just any bank, Barings Bank, the same one that financed the Napoleonic Wars, survived 2 world wars, and managed the Queen's money. Now it was gone. Leeson had been making unauthorized bets on Japanese stock futures and hiding the losses in a secret account. Number 88888. 5 eights, a lucky number in Chinese culture. For him, it became a curse. At first, the losses were small, a few £1,000s. Then they grew to millions. Each time he tried to trade his way out, the hole got deeper. Then came the Kobe earthquake in January 1995. Markets collapsed and Leeson's positions imploded. Within weeks, the hidden account showed losses of over £800 million, twice the bank's total capital. Barings was insolvent. Leeson fled Singapore, leaving a note on his desk that said, "I'm sorry." He was caught in Germany and later sentenced to 6.5 years in prison. By the time the dust settled, Barings, a 233-year-old institution, was sold for just £1. A centuries-old bank wiped out by a single trader. The Hunt brothers' Silver Corner. In the late 1970s, 2 Texas oil billionaires, Nelson and Bunker Hunt, tried to corner the global silver market. Their plan was simple: buy so much silver that they could control its price. At first it worked. The brothers kept buying, using borrowed money, futures contracts, and even physical bullion. By early 1980, they owned or controlled nearly 1/3 of all the silver on Earth that wasn't held by governments. Prices skyrocketed from $6 an ounce to almost $50. Then the regulators stepped in. The commodity exchange, worried the market was being manipulated, changed the rules and limited the amount of silver traders could buy on margin. Suddenly, the Hunts couldn't borrow more money, and they had to start selling. The price collapsed almost overnight, dropping more than 50% in days. The Hunts were wiped out, losing billions and facing charges of market manipulation. The event became known as Silver Thursday. It nearly crashed the commodities market and exposed how even billionaires can get burned by their own greed. Jérôme Kerviel. In January 2008, French trader Jérôme Kerviel woke up to find he'd cost his employer, Société Générale, almost €5 billion, the largest trading loss by one person in history. Kerviel wasn't a high-flying executive. He was a mid-level employee earning about $150,000 a year. Like Nick Leeson years earlier, he'd worked both in trading and back-office operations. He understood how to hide things. For years, Kerviel placed massive unauthorized bets on European stock indexes, positions worth tens of billions of euros. When markets moved his way, he quietly took the profits. When they didn't, he hid the losses behind fake trades and forged emails. His strategy relied on one thing, that no one would check too closely. Then came January 2008. Markets turned volatile. His hidden bets were exposed. Société Générale rushed to unwind his positions, and in just 3 days lost €4.9 billion, more than the bank's entire annual profit. Kerviel said he never did it for himself, only for the company. The courts didn't buy it. He was sentenced to prison and ordered to repay the full amount, a debt he could never possibly pay off. In the end, Société Générale survived. But one trader, acting alone, nearly toppled one of Europe's biggest banks and became the most indebted man on Earth. Long-term capital management. In 1998, a hedge fund called Long-Term Capital Management nearly brought down the global financial system. On paper, it was the smartest fund ever assembled. Its founders included 2 Nobel Prize-winning economists and a team of Wall Street veterans who believed they'd solved the problem of risk. LTCM used complex mathematical models to make small, low-risk bets on bond prices. Each trade earned tiny profits, but the fund used massive leverage, borrowing more than 25 times its capital to magnify returns. As long as markets stayed predictable, the system worked beautifully. Then came the 1998 Russian financial crisis. Russia defaulted on its debt and global markets went haywire. Suddenly, LTCM's safe bets all lost money at the same time. With $4 billion in capital and over $120 billion in exposure, the losses mounted faster than anyone thought possible. Within weeks, LTCM was on the verge of collapse. Its failure threatened to take major banks down with it. The U.S. Federal Reserve stepped in, organizing a $3.6 billion private bailout to prevent a global meltdown. LTCM was eventually liquidated, but its downfall left a lasting warning. Even Nobel Prize winners can blow up the world if they borrow enough money. FTX and Sam Bankman-Fried. In November 2022, FTX, one of the world's largest cryptocurrency exchanges, collapsed almost overnight. At its peak, the company was valued at $32 billion. A week later, it was bankrupt. The founder, Sam Bankman-Fried, had built a reputation as crypto's golden boy. He wore t-shirts and shorts, talked about ethics, and donated millions to political causes. Behind the image, though, his company was quietly taking customer deposits and funneling them to his trading firm, Alameda Research, to make risky bets. When reports surfaced that FTX's balance sheet was filled with its own essentially worthless token, FTT, confidence evaporated. Customers rushed to withdraw billions. There wasn't enough real money to give back. Within days, FTX froze withdrawals, filed for bankruptcy, and revealed an $8 billion hole in its accounts. Bankman-Fried was arrested in the Bahamas and extradited to the U.S. on fraud charges. For crypto investors, it was a harsh reminder. Even in the digital age, the oldest lesson still applies. If something looks too good to be true, it probably is. Weimar Germany, hyperinflation. After World War I, Germany was drowning in debt. The Treaty of Versailles demanded massive reparations, and the government's solution was simple: print more money. At first, it worked. The economy picked up and unemployment dropped. But by 1922, the market began to collapse. Prices doubled every few days. Workers were paid twice a day so they could rush out and buy food before prices rose again. People needed wheelbarrows of cash to buy a loaf of bread. Children played with stacks of worthless banknotes. Restaurants stopped listing prices because they changed every hour. Savings disappeared completely. A lifetime's wealth could barely buy a cup of coffee. By late 1923, one US dollar was worth 4.2 trillion German marks. The middle class was wiped out. The government finally ended the chaos by introducing a new currency backed by land and industry, but the damage was done. The economic devastation and public anger left deep scars, paving the way for extremist politics and eventually another war. Argentina's economic collapse. At the turn of the millennium, Argentina was considered one of South America's economic success stories. Its currency was pegged to the US dollar, inflation was under control, and foreign investors were pouring in. But beneath the surface, debt was piling up, and the economy was stagnating. By late 2001, confidence broke. Argentinians rushed to pull their money out of banks. The government froze accounts, limiting withdrawals to just a few $100s a week. Protests erupted nationwide. People banged pots and pans in the streets, demanding their savings back. Within weeks, chaos consumed the country. There were riots, looting, and violent clashes with police. In just 2 weeks, Argentina went through 5 different presidents. The peso was unpegged from the dollar, and it immediately lost over 70% of its value. By 2002, unemployment hit 25%, and half the country fell below the poverty line. It was one of the largest sovereign defaults in history, $132 billion in unpaid debt. Argentina eventually recovered, but trust in banks and government never fully did. For millions, the collapse turned their life savings into paper. Black Monday. On October 19, 1987, the stock market suffered the largest single-day crash in modern history. The Dow Jones Industrial Average fell 22.6% in just one day, a drop so severe that nothing like it has happened before or since. No one knew exactly why. There was no major war, no oil shock, no major political crisis. Instead, it was a perfect storm of panic, new computer trading systems, and human fear. As prices started falling, computer algorithms designed to limit risk automatically began selling it, which only made prices fall faster. Traders on Wall Street watched as billions in market value disappeared hour by hour. By the end of the day, over $500 billion had been wiped out globally. Investors compared it to 1929, and many feared another Great Depression was beginning. But unlike 1929, the recovery was surprisingly fast. Within 2 years, markets had regained their losses. Still, Black Monday changed finance forever. It exposed how technology and automated trading could magnify human panic in seconds. The Icelandic banking collapse. In 2008, a country with fewer people than Philadelphia managed to trigger one of the biggest banking collapses in modern history. That country was Iceland. For most of the 2000s, Iceland's banks borrowed heavily from abroad to fund aggressive expansion. Their assets ballooned to nearly 10 times the size of the entire Icelandic economy. On paper, the country was rich, but in reality, it was built on debt. When the global financial crisis hit, foreign credit dried up. Suddenly, Iceland's 3 major banks, Kaupthing, Landsbanki, and Glitnir, couldn't pay their debts. Within days, all 3 failed. ATMs stopped working, savings vanished, and the government, overwhelmed, took control of the entire banking system. The Icelandic krona lost more than half its value, and inflation exploded. The country effectively went bankrupt. But unlike most, Iceland chose a different path. It let the banks fail, protected citizens' deposits, and even jailed some of the bankers responsible. It was a brutal collapse, but also a rare story of a nation that refused to bail out its own excess, and somehow came back stronger. The Asian financial crisis. In 1997, a single currency collapse in Thailand set off a chain reaction that nearly brought down all of Asia's emerging economies. It started when Thailand's government ran out of money defending its currency, the baht, which was pegged to the US dollar. When they finally gave up and let it float, the baht's value plummeted, and investors panicked. Money fled the region almost overnight. Indonesia, South Korea, Malaysia, and the Philippines all saw their currencies collapse by as much as 80%. Stock markets crashed, businesses failed, and millions lost their jobs. In Indonesia, inflation soared so fast that food prices tripled in weeks. Protests and riots followed, forcing the country's longtime president Suharto to resign after 30 years in power. The International Monetary Fund stepped in with massive bailout loans, but the austerity measures that followed deepened the pain for ordinary citizens. By the time it was over, trillions in wealth had evaporated. The Asian financial crisis showed how fast global markets could unravel, and how one country's fall could pull an entire region down with it. What do you think was the worst mistake in this video? Let us know in the comments below, and as always, thanks so much for watching. We'll see you very soon.